Hey there. Welcome back. Tonight we're going to talk about the stock market. Not the frantic, blinking numbers version you might have seen in movies, with traders shouting and phones ringing and everyone in a panic. That's not really what we're doing here. What we're going to do is something much quieter than that. We're just going to sit with the idea of it and let it unfold slowly, the way it actually developed over a very long period of time. The stock market is one of those things that most people interact with at some point in their lives, directly or indirectly, but rarely feel like they fully understand. And that's completely fine. Tonight we're not racing toward a finish line. We're just going to ease into it, layer by layer, the way you'd slowly lower yourself into warm water. So get comfortable. There's no rush here at all. Let's start somewhere simple, somewhere almost everyone can relate to, and then we'll move outward from there in gentle, unhurried steps. Imagine you have a bakery, just a small one. You've got a storefront, a couple of ovens, a display case full of things you've made that morning. People come in, buy bread and pastries, and you use that money to buy more flour and butter and keep the whole thing going. The bakery is yours. Every decision, every dollar that comes in, every expense that goes out, all of it runs through you. You are the business, in a practical sense, and the business is you. Now imagine that your bakery starts to do really well. Word gets around the neighborhood. You're selling out every morning before noon. People are asking if you'll open a second location. A bigger kitchen. Maybe a little cafe area where people can sit down with their coffee. You can see it clearly in your mind. You know exactly what the expanded version of your bakery would look like. The only problem is that making it real costs more money than you currently have. You'd need new equipment, a bigger space, more staff. The money to make that happen just isn't sitting in your account. So what do? You have a few options. You could save up for years, slowly putting money aside until you can afford to expand. That works, but it takes a long time, and by then someone else might have opened a similar bakery down the street. You could take out a loan from a bank, borrowing the money you need and paying it back over time with interest. That's a very common path, and it works for a lot of businesses. But there's a third option, one that's older than you might think, and one that eventually grew into something vast and complicated and central to how the entire modern economy works. You could invite other people to own a piece of your bakery. The idea is straightforward when you describe it this way. Instead of borrowing money that you'll have to pay back no matter what, you offer people a share of the business itself. If your bakery is worth, let's say, $100,000 right now, you might decide to sell a 20% stake in it for $20,000. Whoever buys that stake now owns 20% of your bakery. They don't work there. They don't make the croissants. But if the bakery does well and becomes worth $200,000 someday, their 20% stake is now worth $40,000. They've made a profit, not because they did anything in particular, but because the business they partly own grew in value. This is the core of what a share is. It's a small piece of ownership in something. And that concept, stripped all the way down, is what the entire stock market is built around. Of course, the actual stock market is considerably more elaborate than a neighborhood bakery with a few outside investors. But the fundamental logic hasn't changed much. You own a piece of something. If that something grows, your piece grows with it. If it shrinks, so does your piece. The complications come from scale, from the sheer number of companies involved, the sheer number of investors, the machinery built to connect them all, and the layers of rules and traditions and technology that have accumulated over centuries. Let's stay with the simple version for a little while longer though, because it helps to have the foundation clear before we start adding floors to the building. When you sell a piece of your bakery to someone, you and that person have entered into a kind of agreement. They've given you money, and in exchange, they have a claim on a portion of whatever the bakery produces. Not the bread itself, but the financial results. If the bakery makes a profit at the end of the year, your investor might receive a share of that profit proportional to how much of the business they own. That payment, when a company distributes a portion of its earnings to its owners, is called a dividend. It's one of the two main ways an investor can make money from owning a share of something. The other way is simply by selling their share later for more than they paid for it, which is what's called a capital gain. Now let's say your bakery has done so well that you've sold small pieces of it to 30 different people. Some of them invested a lot, some of them just a little. They're spread across the city. They have different ideas about how the business should run. One of them thinks you should open on Sundays. Another thinks you should stop selling gluten-containing products. They all have opinions, because they all have a stake in the outcome. This is already starting to feel slightly complicated, isn't it? Managing all those relationships, tracking who owns what, figuring out how much each person is owed at the end of the year. It requires some kind of system to keep everything organized. Now multiply that by thousands of companies, each with thousands or millions of investors, each share changing hands potentially dozens of times over the years, and you start to understand why the machinery of the stock market exists in the first place. It's fundamentally a system for keeping track of ownership, and for making it possible for ownership to change hands in an orderly way. That second part, the changing hands part, is what makes a market. Because here's a thing worth noticing. When you bought that 20% stake in the bakery, you might have thought you'd hold onto it forever. But what if, a year later, you need the money for something else? What if you've changed your mind? You need a way to sell your stake to someone else. And ideally, you want that process to be easy, quick, and fair. You want to be able to find someone who wants to buy what you're selling, agree on a price, and complete the transaction without too much hassle. That's what a stock exchange is, at its most basic. It's a place, historically a physical place but increasingly a digital one, where people who want to sell shares can find people who want to buy them, and where the price of those shares gets determined by the forces of supply and demand. If a lot of people want to buy shares of a particular company and not many people want to sell, the price tends to go up. If a lot of people want to sell and not many want to buy, the price tends to go down. It's the same principle as any other market, really. The price of apples at a farmer's market, the rent on an apartment, the going rate for a used car. It all comes down to how many people want the thing versus how many of the thing are available. What makes the stock market feel different, more abstract, more intimidating than a farmer's market is partly the speed at which things happen, partly the sheer scale, and partly the fact that what's being bought and sold is something you can't see or hold or eat. A share of stock is a piece of paper, or these days a digital entry in a computer system, that represents a claim on an abstract entity, a corporation, which is itself a legal fiction designed to allow groups of people to pool resources and act as a single unit. There's a lot of abstraction stacked on top of abstraction, and it can make the whole thing feel ungrounded. But if you trace any share of stock all the way back to its origin, you'll find something like our bakery. You'll find a business that needed money to grow, and people who were willing to provide that money in exchange for a share of whatever that growth produced. The complexity we'll be exploring tonight all grew from that basic exchange. Now, it would be a very incomplete picture if we moved forward without acknowledging something important. The stock market isn't just about helping businesses grow. It's also about something that sometimes gets less attention in the friendly explanations, and that's the element of speculation. The word speculation sounds almost clinical, but what it really means is making bets about the future. When you buy a share of stock, you're not just participating in the ownership of a business. You're also making a prediction. You're saying, implicitly, that you believe this company is going to be worth more in the future than it is today. You're betting on that future. But speculation also creates the possibility of prices becoming untethered from any reasonable estimate of what something is actually worth. When a lot of people are betting that a stock is going to go up, and their collective buying pushes the price up, which encourages more people to buy because prices are going up, which pushes prices up further, you can end up in a situation where the price of a company's shares has almost nothing to do with the actual operations or earnings of that company. It's just a number that a lot of people believe will continue rising, until suddenly they don't, and then it falls, sometimes very quickly, back towards something resembling reality. These episodes are what people refer to when they talk about market bubbles, and they've happened with remarkable regularity throughout history, in ways we'll get to later. For now, though, let's just hold those two threads together. The stock market serves a real, practical purpose. It connects businesses that need money with people who have money to invest. And it also serves as a venue for speculation, where people make bets about the future, and where prices are as much a reflection of collective psychology as they are of underlying economic reality. Both of these things are true simultaneously, and much of what seems confusing about financial markets becomes a little clearer when you hold both in mind. Let's think for a moment about what it actually means to be a shareholder. Not in a legal or technical sense, but in a human sense. What does it mean to own a piece of something? When you hold a share of stock in a company, you own a tiny fraction of everything that company owns. Its buildings, its equipment, its intellectual property, its brand, its cash reserves minus its debts. If you own a very large fraction, you might have a meaningful say in how the company is run. Most shareholders vote on major decisions, like who sits on the board of directors, which is the group of people ultimately responsible for overseeing management. But if you own a very small fraction, say 100 shares of a company that has 10 billion shares outstanding, your actual influence on the company's decisions is essentially zero. You're along for the ride. You're betting on the outcome, but you're not steering. This is fine for most investors, because what they care about isn't control. What they care about is return. They want the value of their investment to grow over time. And historically, over long enough periods of time, owning shares of well-run businesses has been one of the better ways to grow wealth. Not a sure thing. Never a sure thing. But over decades, the broad trend has been upward, because businesses generally grow, and as they grow, the value of a share in them tends to grow too. There's something almost meditative about the long view in investing. If you zoom in too closely, on any given day or week or even year, the stock market can look chaotic, unpredictable, even frightening. Prices jumping up and down in response to news events, economic reports, geopolitical developments, rumors, sentiment shifts, fear and greed cycling through the market in waves. But if you pull back and look at a chart of, say, the last 100 years of stock market performance, a very different picture emerges. The zigzags are still there, sometimes dramatically so, but underneath them is a slow, persistent upward slope. The market, on the whole, over long stretches of time, has tended to grow, because the economy has tended to grow, because human ingenuity and effort have persistently created more value over time than they've destroyed. That's a very broad, smooth statement, and it glosses over a lot of real pain that a lot of real people have felt during the downturns. We'll get to those. But it's worth holding that long view perspective in mind as we continue, because one of the most common mistakes people make when thinking about markets is looking at them through too short a lens. Let's move now toward thinking about the different kinds of companies that trade on stock markets, because they're not all bakeries. They're not all small businesses with a clear physical product. The stock market includes companies of almost every kind and size imaginable, and understanding the variety helps clarify what you're actually engaging with when you participate in it. At one end of the spectrum, there are enormous, established companies. Companies that have been around for decades, that have hundreds of thousands of employees, that operate in dozens of countries, whose products or services are woven into the fabric of everyday life. These companies tend to be relatively stable. Their earnings are fairly predictable. They've survived multiple recessions. They often pay regular dividends, returning a portion of their profits to shareholders on a scheduled basis. Investors who own shares in these companies are often looking for steady, reliable growth rather than sudden dramatic gains. They want something closer to the slow accumulation of value over years, not a lottery ticket. At the other end of the spectrum, there are small, young companies. Companies that might have a single product, or even just an idea, and a team of people working to build something. These companies might not be making any profit at all right now. They might be spending heavily on research and development, on hiring, on marketing, on building the infrastructure they'll need to scale up. Investors who buy shares in these companies are taking on much more risk. The company might fail entirely, in which case those shares become worthless. But if it succeeds, if it grows from a small startup into a major business, the early investors can see enormous returns. They might pay $1 a share for something that ends up being worth $100 a share a decade later. Most companies fall somewhere in between these extremes. They have some track record, some earnings, some growth, but also some uncertainty. And the price of their shares reflects, in theory, a collective assessment of where they are on that spectrum and what their future looks like. There are also what are called sectors, which are broad categories of industry. You have technology companies. You have healthcare companies. You have energy companies, financial companies, consumer goods companies, real estate companies, utilities, manufacturing, transportation. Each sector tends to have its own rhythms, its own relationship to the broader economy, its own patterns of when it tends to do well and when it tends to struggle. Energy companies, for example, are heavily influenced by the price of oil and natural gas, which can swing quite dramatically. Utility companies, which provide things like electricity and water, tend to be more stable because people need those things regardless of economic conditions. Technology companies can grow very fast when their products catch on, but they can also fall very fast when sentiment shifts or competition intensifies. Understanding that the stock market isn't a single monolithic thing, that it's a vast collection of different companies in different industries at different stages of development, with different risk profiles and different growth trajectories, helps to demystify a lot of the confusion. When people say, "The market is up today," they're usually referring to a broad index, an average of many companies' share prices, not every single company in existence. Some companies go up every day the market goes down. Others go down when everything else seems to be going up. The diversity within the market is enormous. Now let's slow down a little and think about indexes, because they're a concept that comes up constantly when people talk about the stock market, and they're actually quite simple once you see what they're doing. An index is just a way of measuring the performance of a group of stocks. The most famous one, probably, is the Dow Jones Industrial Average, often called simply the Dow. You've likely heard that phrase. In the news, someone might say the Dow was up 200 points today, or the Dow fell 3% this week. What they're talking about is a specific calculation based on the share prices of 30 large American companies, a representative sample of major industries. When most of those companies' share prices go up, the Dow goes up. When most of them go down, the Dow goes down. It's a convenient shorthand for, how did the stock market broadly do today? The S&P 500 is another widely watched index, one that tracks 500 large American companies rather than just 30. It's considered by many professional investors to be a better gauge of the overall market because it's broader. The Nasdaq is another, which tends to be weighted more heavily toward technology companies. These indexes serve a few purposes. They give investors and analysts a quick way to assess how the market as a whole is performing. They serve as benchmarks against which individual investors can measure their own portfolio's performance. And they've given rise to an entire category of investment products called index funds, which are designed to simply match the performance of a particular index rather than trying to beat it. We'll talk more about index funds a little later, because they've had a profound effect on how ordinary people participate in markets. For now, the key thing to understand about an index is that it's an abstraction. It takes something enormously complex, hundreds or thousands of individual companies all doing their own things, and reduces it to a single number that goes up or down every day. That number is useful, but it hides a vast amount of detail. 2 days when the market was flat might be very different from each other at the company by company level. One might be a day when some companies rose dramatically and others fell dramatically, and they mostly canceled each other out. Another might be a day when almost everything drifted slightly in both directions with no strong movement anywhere. The index looks the same, but the underlying reality is quite different. There's something calming, in a way, about the aggregate view. The broad index smooths out a lot of the noise. And there's something instructive about it, too. It reminds you that markets, on average, over time, tend to reflect the general health of the economy, and that the general health of the economy, despite its many turbulent periods, has a long-term upward trend. Not everywhere, not always, not without real suffering along the way. But as a broad pattern, it holds. Let's think now about how someone actually buys a share of stock, because the mechanics of it are interesting, and they've changed a great deal over the centuries. In the very early days of stock markets, buying and selling shares was a physical, in-person affair. You had to go to where the trading happened. You had to find a broker, a person who specialized in connecting buyers and sellers, and you had to tell them what you wanted to buy and at what price, and they would go and find someone willing to sell at that price, and a transaction would occur. The whole process might take hours or days. There were physical certificates, pieces of paper, that changed hands. You'd receive a document stating that you owned a certain number of shares in a certain company. As stock markets grew larger and more active, the process became more formalized. Exchanges were established, physical buildings where brokers would gather and conduct trades. The floor of the New York Stock Exchange, for example, was for many decades a place of organized chaos, with hundreds of people in colored jackets shouting and gesturing, using hand signals and specialized slang to communicate, buy and sell orders rapidly. It was loud and physical and urgent in a way that's hard to imagine now, and it required a whole community of people whose job was simply to stand there and help match buyers with sellers as efficiently as possible. Technology gradually transformed all of this. The telegraph made it possible to transmit trade orders over long distances quickly. The telephone made communication faster still. And then computers, first large and centralized, then smaller and more distributed, eventually made it possible to execute trades electronically, without anyone physically shouting anything at anyone. The process accelerated dramatically. Where it once might take minutes or hours to complete a transaction, electronic trading systems could do it in fractions of a second. Today, when you want to buy a share of stock, the process from your perspective is extraordinarily simple. You open an account with a brokerage firm, which can be done online in a matter of minutes. You deposit some money. You search for the company you want to invest in, type in the number of shares you want to buy, and press a button. The actual mechanics behind that button press are complicated, involving multiple computer systems, clearinghouses, regulatory checks, and settlement processes. But from where you're sitting, it takes about as long as ordering a book online. The democratization of this process has been remarkable. For most of the stock market's history, participating in it meaningfully required either substantial wealth or access to professional advisors. Commissions on trades were high, often a fixed fee plus a percentage of the trade, which made small investments uneconomical. The information needed to make informed investment decisions was difficult to obtain and often available only to professionals. None of this is true anymore, or at least much less so. Today, many brokerage firms offer commission-free trading. Financial information is available to anyone with an internet connection. Investment platforms designed for ordinary people have made it possible for someone with $50 and a smartphone to buy shares in publicly traded companies. Whether this democratization has been entirely positive is a more complicated question than it might first appear, and we'll touch on some of the complications later. But as a simple fact, the barriers to entering the stock market have fallen dramatically over the past few decades. Let's shift now and think about why a company might choose to go public in the first place. Because that phrase, going public, is one you encounter often and it's worth understanding clearly. A private company is one that isn't traded on a public stock exchange. Its shares are owned by a relatively small number of people, the founders, early employees who receive stock as part of their compensation, venture capital investors who back the company in its early stages, and perhaps a handful of others. These shares don't change hands in a public marketplace. If you own them and want to sell them, you have to find a private buyer, which can be complicated. A public company is one that has gone through a process called an initial public offering, or IPO, in which it offers shares of itself for sale on a public stock exchange. After an IPO, anyone with a brokerage account can buy shares in the company. The shares trade freely every day the market is open. Why would a company choose to do this? The most obvious reason is money. An IPO can raise enormous amounts of capital very quickly. When a company sells shares to the public for the first time, it receives the proceeds from those sales. A large, successful IPO can raise hundreds of millions or even billions of dollars in a single day. That money can fund expansion, research, debt repayment, acquisitions, or whatever else the company's leadership decides it needs. There are other reasons too. Going public can raise a company's profile and credibility. It can provide a way for early investors and employees to convert their private shares into cash, a process sometimes called a liquidity event, which is a rather dry phrase for something that can be genuinely life-changing for the people involved. And having publicly traded shares can make it easier to use those shares as currency. For example, to compensate employees with stock options or to acquire other companies. But going public also comes with costs and constraints. Public companies are required to disclose enormous amounts of financial information on a regular basis. They face scrutiny from analysts, journalists, and millions of investors who all have opinions about how the company should be run. They have to hold shareholder meetings, issue quarterly earnings reports, and operate in the constant glare of public attention in a way that private companies don't. Some founders and executives find this liberating. Others find it exhausting and distracting. The IPO process itself is a fascinating ritual of modern finance. It typically involves hiring investment banks to help value the company and market its shares to potential investors. There's a process called a roadshow in which company executives travel to meet with large institutional investors and make the case for why they should buy in. There's a negotiation over price, an attempt to figure out what price will maximize the amount raised while still leaving some upside for the initial investors. And then there's the first day of trading, which is often attended to with great excitement and covered by financial news media. A stock that opens significantly higher than its offering price is said to have popped, which can feel like a success, though it also means the company raised less money than it might have if the shares had been priced higher to begin with. The valuation of a company, that is, the question of how much it's worth, is one of the more intellectually interesting puzzles in finance, and it's worth spending a little time on because it connects the abstract world of share prices to the real world of business operations. When you buy a share of stock, what are you actually buying? You're buying a small piece of a going concern, a business that's expected to continue operating, to continue generating revenue, to continue paying costs, and ideally to generate some profit along the way. The value of that piece depends on how much profit the business is expected to generate in the future. This sounds deceptively simple. If a company earns $10 million in profit this year, and you own 1% of it, you're entitled to $100,000 of that profit, either as a dividend or as an increase in the company's value. So you might think the company should be worth $100 million because it earns $10 million per year. But it's not that simple, for a few reasons. First, the profit this year might not be the same as the profit next year. If the company is growing rapidly, next year's profit might be much higher, and the year after that higher still. Investors willing to own a piece of such a company will pay a premium today for the right to participate in that future growth. This is why fast-growing companies often trade at what seem like extraordinarily high prices relative to their current earnings. Investors aren't paying for what the company is earning now. They're paying for what they believe it will earn in the future. Second, there's the concept of time value of money. A dollar received today is worth more than a dollar received in 10 years, because a dollar you have now can be invested and grow, while a dollar you won't receive for 10 years just sits in the future, earning nothing. This means that when you're valuing a company based on its expected future earnings, you need to discount those future earnings back to today's value, accounting for the fact that future money is worth less than present money. This process of discounting future cash flows is one of the fundamental techniques of financial valuation, and it involves a lot of assumptions about growth rates and discount rates and time horizons that can lead thoughtful analysts to very different conclusions about what a company is worth. Third, there's uncertainty. Nobody actually knows what a company will earn next year, let alone in 10 years. The future is unknown. Businesses face competition, technological change, shifting consumer preferences, economic downturns, regulatory changes, and countless other forces that can make a currently profitable company much less profitable. or even bankrupt. This uncertainty is why investors require a return on their investment. If there were no uncertainty, if you could guarantee that owning shares would return you a known amount every year with no risk of loss, people would be willing to pay a much higher price for those shares. The presence of risk means investors need to believe they're being compensated for taking that risk, which means they'll only pay a price that gives them a reasonable expected return. All of this is what analysts and investors are trying to figure out when they value a company. They're building models of the future, making assumptions, running calculations, and arriving at a number that they believe represents a fair price. And then the market, the collective judgment of millions of buyers and sellers, produces a price too. The difference between what an analyst thinks a company is worth and what the market says it's worth is where a lot of investment strategies are born. If you believe a company is worth more than the market thinks it is, you buy. If you think it's worth less, you might sell or avoid it. Getting those judgments right, consistently, over time, is very hard to do, which is why most professional investors, those who try to beat the market by being smarter than the collective, mostly fail to do so over long periods. That observation about the difficulty of consistently outperforming the market is the seed from which a very important and somewhat counterintuitive idea grew. The idea is often called the efficient market hypothesis, and it's worth understanding at least in broad terms because it has profound implications for how ordinary people should think about investing. The efficient market hypothesis, at its most basic, says that asset prices reflect all publicly available information. In other words, if there's publicly available information suggesting that a company is undervalued, investors will act on that information, buying up the stock and driving the price up until it's no longer undervalued. The market, as the aggregate of many informed participants, is extremely good at incorporating information into prices. This makes it very hard for any individual investor or any professional fund manager to consistently find stocks that are mispriced in ways that offer an above-average return. The hypothesis comes in different forms, some strong, some weak, and economists debate the details. Markets are clearly not perfectly efficient all the time. Prices do sometimes move in ways that seem difficult to explain by reference to rational information processing. Bubbles happen. Crashes happen. But the broad principle, that it's very hard to consistently do better than the market average, has a great deal of empirical support. Study after study has shown that most actively managed mutual funds, funds where professional managers pick stocks in an attempt to outperform the market, failed to do so after accounting for the fees they charge over periods of 10 or 20 years. This is why index funds became so popular. An index fund doesn't try to beat the market. It just tries to match it. It buys all the stocks in a particular index in proportions that match their weight in that index, and it holds them. Its costs are very low because it doesn't require teams of analysts and portfolio managers to pick stocks. And because it's not paying those costs, and because it's not making active decisions that might turn out to be wrong, it tends to do better than most actively managed funds over long periods of time. There's something almost philosophically interesting about this. The investor who does best, over long periods, is often the one who does the least. who resists the urge to buy and sell based on their own judgment, who accepts whatever return the market gives, who doesn't try to be clever, who is patient and passive and content to just own a little piece of everything. The most sophisticated thing you can do in investing, for most people, most of the time, is to do almost nothing. That's a strange conclusion to arrive at after all this discussion of analysis and valuation and information processing, but it's one that the evidence supports fairly strongly. Of course, this doesn't mean the market is static or boring. Far from it. Even if you're an index fund investor, content to ride the overall market wherever it goes, the overall market goes on a remarkable journey over time, with peaks and valleys and long stretches of going nowhere and sudden sprints upward. Understanding the rhythms of those movements, even at a very general level, helps make sense of what's happening when you watch your portfolio fluctuate. Let's talk about cycles, because the stock market has them, and they're worth understanding. The economy, the broad system of production and consumption and employment that underlies stock market performance, tends to move in cycles. There are periods of expansion, when economic output is growing, unemployment is falling, businesses are profitable, and people are spending. And there are periods of contraction or recession, when economic output is shrinking, unemployment is rising, businesses are struggling, and spending slows. Stock markets tend to anticipate these cycles rather than simply reflect them. Because investors are always trying to predict the future, they often start buying stocks before a recovery is clearly underway, and they often start selling before a recession is officially declared. The market is said to be forward-looking, meaning it's always trying to price in what's coming, not just what is. This forward-looking quality means that the relationship between stock prices and current economic conditions can be confusing. A market might be going up even while the economy is still contracting, if investors believe a recovery is coming. A market might be going down even when current economic data looks strong, if investors believe trouble is on the horizon. The market, you sometimes hear people say, is not the economy. This is true in an important sense. They're related, but they're not the same thing. Within the broad cycle of expansion and contraction, there are also what practitioners call bull markets and bear markets. These terms have been around for a very long time, and their exact etymology is disputed, though various explanations exist about the way a bull attacks by thrusting upward with its horns and a bear by swiping downward with its paws. Whatever the origin, the meaning is clear. A bull market is one in which prices are generally rising. A bear market is one in which prices are generally falling, typically defined as a decline of 20% or more from a recent high. Bull markets can last for years, even for a decade or more. The one that ran from roughly 2009 to 2020 in the United States was one of the longest in history. During that time, stock prices rose steadily, with occasional short disruptions, as the economy recovered from the financial crisis of 2008 and 2009 and then continued to grow. Investors who held their positions throughout that period saw significant gains. Bear markets, by contrast, tend to be shorter but more intense. The average bear market lasts roughly 18 months, though some have been much shorter and a few have been much longer. They're accompanied by anxiety and uncertainty, and they test the patience and nerve of investors who have to watch the value of their portfolios decline, sometimes substantially, before the eventual recovery. The emotional experience of a bear market is worth describing, because understanding it helps explain some of the behaviors that markets display. When prices are falling and the news is bad and everyone around you seems to be worried, the instinct is often to sell. To get out before things get worse. To cut your losses. This is a very human response to perceived danger. The problem is that selling during a decline locks in your losses and means you're likely to miss the eventual recovery, which often happens quickly and without much warning. The investors who do worse during bear markets are often those who sell at the bottom, when fear is at its peak, and then wait too long to buy back in, after prices have already recovered substantially. They lock in the losses, miss the gains. This is why so much of investing wisdom comes down to emotion management, to the ability to hold course when the instinct is to flee, to remember that the market has always, historically, eventually recovered, to trust in the long view even when the short view is frightening. None of this is easy. It's one thing to understand it intellectually and another to feel the value of your retirement savings dropping and maintain equanimity. But the investors who manage it, who stay the course through the downturns and hold their positions through the recoveries, tend to come out significantly ahead of those who react to every shift in sentiment. Let's move now to thinking about what actually moves stock prices on a day-to-day basis. Because even if you're a long-term, passive investor who doesn't care much about daily fluctuations, understanding what drives them is part of understanding how markets work. The most fundamental driver of stock prices, in theory, is what's called earnings. A company's earnings, its profit, the difference between what it takes in and what it spends, are the clearest indicator of its financial health and the best predictor of its ability to generate value for shareholders. When a company reports earnings that exceed what analysts expected, its stock price often rises. When it reports earnings that disappoint, the stock often falls. Earnings season, the roughly quarterly period when most public companies report their financial results, tends to be a period of heightened activity in the markets as investors react to what they learn. But earnings aren't the only thing that moves prices. Interest rates have a major influence. When central banks raise interest rates, as the Federal Reserve in the United States or the European Central Bank do when they're trying to reduce inflation, a few things happen. Borrowing becomes more expensive, which can slow down economic growth and reduce corporate profits. The return available from safer investments, like government bonds, becomes more attractive, which can make the relatively risky returns from stocks seem less appealing by comparison. And the discount rate used to calculate the present value of future earnings goes up, which mathematically reduces the calculated value of companies, especially fast-growing ones whose value is concentrated in distant future earnings. Macroeconomic data also moves markets. Reports on employment levels, consumer spending, manufacturing activity, inflation, and other broad economic indicators all tell investors something about the health of the economy and what they might expect from corporate earnings in the coming months. A strong jobs report can boost stocks. A report suggesting that inflation is rising faster than expected can depress them. Geopolitical events, too, can move markets quickly. Wars, elections, trade disputes, regulatory changes, natural disasters, pandemics. The stock market is sensitive to uncertainty, and anything that increases uncertainty, that makes the future harder to predict, tends to cause prices to fall, at least initially, as investors recalibrate their assumptions. And then there's sentiment, that harder to define but very real force that reflects the aggregate mood of the market. Are investors generally feeling optimistic or pessimistic? Are they eager to buy or anxious to sell? Sentiment can shift based on things as intangible as the tone of a central bank chairman's speech, or a tweet from a prominent executive, or a news story that captures the public's attention. Markets are made of human beings, and human beings are emotional, social creatures who are influenced not just by data but by stories, by the moods of their peers, by the general sense of whether things feel like they're going well or going badly. This susceptibility to sentiment is what creates the conditions for the bubbles and crashes that punctuate market history. When sentiment is extremely positive, when everyone is optimistic and prices are rising and it feels like anyone who's invested is getting rich, the temptation to extrapolate that feeling indefinitely into the future is very strong. People buy at high prices because they believe prices will go even higher. The self-reinforcing nature of that process is what inflates a bubble. And when sentiment shifts, when cracks appear in the optimistic narrative and fear begins to replace greed, the process reverses. People sell because prices are falling. Prices fall because people are selling. And the self-reinforcing nature of that process is what crashes a bubble. History is full of these episodes, and they're worth touching on gently because they illustrate something important about human nature and markets. One of the earliest documented speculative bubbles occurred in the Netherlands in the 1630s. It involved tulips, of all things. Tulips had been introduced to Europe from the Ottoman Empire in the previous century and had become enormously fashionable, particularly among the Dutch merchant class, who were prospering greatly from their nation's commercial empire. Certain rare varieties of tulips, those with unusual color patterns caused by a virus, had become status symbols. Their prices rose. People noticed the prices rising and began buying not to enjoy tulips but to profit from rising prices. Futures contracts appeared, promises to deliver tulips at a future date for a price agreed upon today, which allowed speculation to expand beyond the actual supply of tulip bulbs. At the peak, a single rare tulip bulb was reportedly trading for more than a skilled craftsman might earn in a year. And then it collapsed. In February of 1637, tulip prices fell suddenly and dramatically. The reasons are somewhat disputed by historians, and some accounts of the episode have been exaggerated over the years. But the basic shape of it, the rapid price inflation driven by speculation rather than genuine utility, followed by an equally rapid collapse, has been repeated in recognizable form many times since. The South Sea Company in Britain in the early 1700s. The railroad mania of the 1840s. The speculative fervor surrounding real estate and financial innovation in the 1920s that preceded the Great Crash of 1929. The dot-com bubble of the late 1990s, when companies with no earnings and sometimes no real business model commanded stratospheric valuations because they had websites. The housing bubble of the mid-2000s built on the belief that real estate prices would rise indefinitely, and on financial products that made it easy to borrow money you couldn't really afford. Each of these episodes had its own particular cast of characters, its own specific mechanisms, its own particular story. But the underlying psychology was remarkably consistent. A new opportunity appears. Early investors profit. Others notice and join in. Prices rise. Rising prices attract more buyers. The narrative that justifies rising prices becomes more elaborate and confident. Skeptics are dismissed as behind the times. And then, eventually, the prices become impossible to sustain, the narrative breaks down, and the unwinding begins. One of the things worth noticing about these episodes is that the people involved weren't stupid. Many of them were quite sophisticated. Some of them were wealthy and educated and experienced. The behavioral patterns that produce bubbles seem to arise not from ignorance, but from something more fundamental about how humans process information in social settings. We look at what other people are doing. We update our beliefs based on the behavior of our peers. We are drawn to narratives that tell us the future will be better than the past. And we are subject to what psychologists call FOMO, the fear of missing out, the anxiety that if we don't act now, we'll be left behind while everyone else gets rich. These tendencies serve us well in many contexts. They're the reason humans cooperate and learn from each other and build on each other's innovations. But in markets, under certain conditions, they can produce collective behavior that ends up being very costly. None of this means that the stock market is fundamentally a scam or a fool's game. The episodes of mania and panic are real, but they're interspersed with much longer periods of steady, rational price discovery, of companies growing and shareholders benefiting in proportion. The challenge is navigating the emotional landscape, maintaining perspective when things get frothy, and not abandoning a sensible long-term strategy because of short-term noise. Let's take a step back now and think about the history of the stock market itself, because it has a longer and more interesting history than most people realize. And tracing that history helps illuminate why things are the way they are today. The earliest versions of what we might recognize as stock markets emerged in the Netherlands and England in the early 17th century. This was an era of intense commercial activity and global expansion. European powers were building trade networks that stretched to the Americas, to Africa, to Asia. The voyages required to sustain these networks were enormously expensive. They required ships, cargo, crews, navigation equipment, supplies for months at sea. They also involved substantial risk. A ship might sink. It might be captured by rivals. The cargo might spoil, or the market for it might shift in the years it took to complete the voyage. To manage these risks and to mobilize the capital needed for such ventures, merchants began forming joint stock companies. The idea was straightforward. Instead of one wealthy merchant risking everything on a single voyage, a group of investors would each contribute a share of the capital needed, and each receive a proportional share of the profits if the voyage succeeded. If the ship went down, no single investor lost everything. They each lost only their share. The risk was distributed. The Dutch East India Company, founded in 1602, is often cited as the first modern joint stock company in the sense that its shares were freely transferable and tradable. The company was given a monopoly on Dutch trade in Asia, which was enormously profitable, and investors who had bought in early were eager to sell their shares at a profit, while others who had missed the initial offering were eager to buy. A secondary market in the shares developed, and this secondary market, conducted initially in a particular building in Amsterdam, and later in a purpose-built exchange, is often considered the first recognizable stock exchange in history. The Amsterdam Stock Exchange traded not just shares in the Dutch East India Company but eventually shares in other companies, as well as commodities and eventually, early forms of financial derivatives, contracts that derive their value from the underlying price of a stock or commodity. The sophistication of Amsterdam's financial markets in the 17th century was remarkable. Many of the instruments and concepts that seem like modern inventions, short selling, options, futures, leverage trading, were practiced in Amsterdam 400 years ago. England was not far behind. The London Stock Exchange has roots going back to the late 17th century, when traders and brokers who had been conducting business in coffee houses found that the informal arrangements weren't adequate for the growing volume of trade. Jonathan's Coffee House in particular was a popular gathering spot for those who bought and sold shares, and it eventually evolved, through various reorganizations over the following century, into what became the formal London Stock Exchange. The United States came to have the world's dominant stock markets somewhat later. The New York Stock Exchange traces its origins to a meeting of brokers under a buttonwood tree on Wall Street in 1792, at which they signed the Buttonwood Agreement establishing basic rules for conducting trades in securities. Lower Manhattan, which was already a center of commerce in the young republic, became the hub of American financial activity, and the stock exchange that developed there grew steadily in importance as the American economy grew. The 19th century was a period of explosive growth for American financial markets. The Industrial Revolution was transforming the economy, creating enormous capital needs for railroads, factories, mines, and all the infrastructure of a modernizing nation. Companies needed to raise vast sums of money to build these things, and the stock market provided a mechanism for doing so. The railroad industry in particular drove much of the market's growth in the mid-19th century. Thousands of miles of track were laid, and the companies laying them were financed in significant part through public markets. This period also saw some of the most dramatic financial panics of American history. The Panic of 1873, the Panic of 1893, and others were episodes in which credit contracted sharply, banks failed, companies went bankrupt, and the economy entered severe recession. The stock market fell dramatically during these episodes, and they caused genuine hardship for millions of people. But they were followed, each time, by recovery and renewed growth, though that recovery could take years and the hardship in the meantime was very real. By the early 20th century, New York had emerged as the preeminent financial center of the world. The New York Stock Exchange was the world's largest and most active market. American industry was producing an enormous share of the world's goods. The economy was growing rapidly. And in the 1920s, a bull market of extraordinary proportion took hold. The Roaring Twenties, as the decade is often called, was a period of genuine economic prosperity, of rising wages and increasing standards of living, but also of intense speculative activity in the stock market. Ordinary Americans, not just wealthy investors, were buying stocks on margin, meaning they were borrowing money to invest, betting that prices would continue to rise so they could repay the loans and pocket a profit. When the crash came in October of 1929, it was severe. Over the course of a few days, stock prices fell dramatically. Many investors who had borrowed to invest found that the value of their holdings had fallen below the amount they owed, and they were ruined. Banks that had extended credit for stock purchases were threatened. The contraction rippled through the economy over the following years in what became the Great Depression, the most severe economic downturn of the 20th century, during which unemployment rose dramatically and economic output fell sharply. The stock market, which had peaked in September 1929, didn't return to those levels until the 1950s. The lessons drawn from the 1929 crash and the Great Depression shaped financial regulation for decades. In the United States, the Securities Act of 1933 and the Securities Exchange Act of 1934 established new requirements for companies issuing securities and created the Securities and Exchange Commission, the regulatory body that oversees stock markets. The Glass-Steagall Act separated commercial banking from investment banking, a separation that lasted until the late 1990s. These regulations were designed to prevent the excesses and frauds that had contributed to the crash and to provide investors with better information and protection. The decades following the Depression and the Second World War were a period of relative stability and gradual growth for American stock markets. The post-war economic expansion was real and broad, and the stock market reflected it. Institutional investors, mutual funds, pension funds, insurance companies grew in importance as vehicles through which ordinary people could participate in market growth indirectly. The second half of the 20th century saw the rise of what's often called the cult of the equity, a broad cultural shift in which owning stocks became not just something wealthy investors did but an aspiration and eventually an expectation for middle-class Americans saving for retirement. The employer-sponsored pension system, which had been the dominant retirement vehicle in the post-war decades, gradually gave way to individual accounts, 401k plans and IRAs, in which workers made their own investment decisions. This shift pushed more ordinary people into direct or indirect contact with the stock market, and it made market performance directly relevant to the retirement security of millions of households. By the 1990s, individual investors were a substantial and growing presence in the market. Discount brokerage firms had reduced trading costs significantly. The Internet made financial information widely available for the first time. The bull market of the 1990s, driven in large part by genuine technological innovation and the growth of the Internet economy, attracted enormous attention and enthusiasm. And as we've already noted, That enthusiasm eventually curdled into the dot-com bubble, whose collapse in 2000 and 2001 wiped out trillions of dollars of paper wealth. The recovery from that crash was underway when a different kind of crisis emerged. The financial crisis of 2007 and 2008 grew from the collapse of a massive bubble in the American housing market and the complex financial instruments that had been constructed on top of it. Mortgage-backed securities, which pooled together thousands of individual home loans and sold slices of the resulting income stream to investors, had become enormously popular. Rating agencies had given many of these securities top credit ratings despite the underlying risk. When housing prices began to fall, and borrowers began defaulting on loans they couldn't afford, the value of these securities collapsed, threatening the solvency of major financial institutions. The result was a financial crisis of a severity not seen since the Great Depression. Several major financial institutions failed or had to be rescued with government funds. Credit markets froze. The stock market fell dramatically. The recession that followed was severe, and its effects on employment and living standards were felt for years. Stock prices, which had peaked in October 2007, bottomed out in March 2009 and then began the long recovery that would eventually, as mentioned, produce one of the longest bull markets in history. The financial crisis prompted another round of regulatory reform. The Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010 was the most comprehensive overhaul of financial regulation since the New Deal. It created new regulatory agencies, imposed new requirements on financial institutions, and attempted to address some of the structural vulnerabilities that had contributed to the crisis. Whether it succeeded fully in doing so remains a subject of debate among economists and policymakers. What the history of these crises and recoveries shows, more than anything, is the resilience of market systems over time and the recurring nature of the patterns. Each crisis is different in its specific mechanics. Each produces genuine harm, and each is followed, eventually, by recovery. The cycle has repeated across centuries, in different countries, under different regulatory regimes, with different technologies and different financial instruments. The underlying human dynamics, the interplay of optimism and fear, the tendency to extrapolate trends, the occasional mismatch between prices and underlying value, seem to be relatively constant features of how human beings collectively manage capital and uncertainty. Let's think now about some of the other players in the stock market, because it's not only individual investors and the companies whose shares are traded. The ecosystem is considerably larger. Investment banks occupy a central position. These are institutions that help companies raise money, either through issuing stock or through issuing bonds. They underwrite IPOs, meaning they buy the shares from the company and then sell them to investors, taking on the risk that they won't be able to sell all of them at the offering price. They advise companies on mergers and acquisitions. They trade securities on their own account. They create and sell financial products to institutional clients. The major investment banks are among the most powerful and profitable financial institutions in the world, and they have enormous influence over how capital flows through the economy. pension funds and insurance companies are major long-term investors. Pension funds, which manage retirement money on behalf of workers, are some of the largest holders of stocks and bonds in the world. Because they have long time horizons, they tend to take a measured, patient approach to investing. They're less likely to panic and sell during a downturn, more likely to rebalance their portfolios gradually. Insurance companies, which collect premiums and need to invest them to be able to pay future claims, similarly tend toward a conservative, long-term approach. Hedge funds are a more complex and varied category. They're private investment vehicles open only to wealthy individuals and institutions, subject to fewer regulatory constraints than ordinary mutual funds, and employing a much wider range of investment strategies. Some hedge funds focus on equity investments, essentially doing what a sophisticated stock picker does. Others use complex derivative strategies. Some try to profit from arbitrage, exploiting small price discrepancies between related securities. Some take positions on currencies or commodities. The phrase hedge fund is almost a misnomer at this point, because many of them don't actually hedge their risks in any traditional sense. They've evolved into a broad category of sophisticated, often highly leveraged investment vehicles. Sovereign wealth funds are investment funds controlled by national governments, often funded by revenues from natural resources like oil. Countries like Norway, Saudi Arabia, Kuwait, and Singapore have enormous sovereign wealth funds that invest in stocks and other assets around the world. These funds can be very large, and their investment decisions can have meaningful effects on the prices of the assets they're buying or selling. And then there are the index fund and ETF providers, the passive investment managers like Vanguard, BlackRock, and State Street, which have grown to manage enormous amounts of money. An ETF, or exchange-traded fund, is like an index fund in that it tracks a particular index, but it trades on a stock exchange throughout the day like a regular stock rather than being priced once at the end of the day like a traditional mutual fund. ETFs have become enormously popular because of their low costs, flexibility, and broad diversification. The growth of passive investing has been one of the most significant developments in financial markets over the past few decades. The rise of passive investing raises some interesting questions. If more and more investors are simply buying index funds, which own all the stocks in an index in proportion to their market capitalization, who is doing the work of price discovery? Who is figuring out which companies are worth more and which are worth less? Active investors, those who research individual companies and make judgments about their value, are the ones who keep prices more or less aligned with underlying reality. If everyone were passive, there would be no mechanism for prices to reflect new information. The market couldn't function. But as long as there are enough active investors out there doing the hard work, the passive investors can free ride on their efforts. And so far, the market seems to be functioning, though there's ongoing academic debate about whether the growth of passive investing is subtly distorting prices in ways that aren't yet fully understood. There's also the phenomenon of algorithmic trading, sometimes called high-frequency trading, which has transformed the mechanics of how markets operate in recent decades. High-frequency trading firms use sophisticated computer algorithms to analyze market data and execute trades in milliseconds, often profiting from tiny discrepancies in prices across different exchanges or from patterns in the order flow. These firms now account for a substantial fraction of total trading volume in many markets. Their presence has both reduced transaction costs in some ways, by providing liquidity and narrowing the spread between the prices at which you can buy and sell, and raised concerns in others about whether their speed advantage gives them an unfair edge over slower investors and whether their algorithms might, in certain market conditions, amplify volatility rather than dampen it. The flash crash of May 2010, when the stock market fell nearly 10% in a matter of minutes before recovering almost as quickly, is often cited as an example of how algorithmic trading can interact with market conditions in unexpected and destabilizing ways. The full sequence of events that produced that episode is quite complex, and investigators found that no single cause could explain it entirely. But it illustrated vividly how a market dominated by automated systems, responding to each other's behavior faster than any human can observe, might occasionally produce outcomes that no individual participant intended or expected. Technology more broadly has been one of the most powerful forces shaping how markets operate. We've already talked about how electronic trading replaced the open outcry pits of physical exchanges. But technology has also transformed how information spreads through markets. In the era before instant communication, a company's earnings report might take days to reach all investors. Today, it's instantly available to anyone with a news feed. Prices react in real time to new information, which is one of the mechanisms that makes markets more efficient. But it also means that the pace of reaction has accelerated, and the window of time in which an investor might act on information before others do has compressed dramatically. The rise of financial news media, from CNBC to Bloomberg to financial Twitter and beyond, has created a constant flow of commentary, analysis, prediction, and noise about markets. Whether this has made markets more informed or simply more frenetic is debatable. There's a case that the endless availability of information and commentary makes it harder for individual investors to distinguish signal from noise, that it creates the temptation to check your portfolio too often, to react to short-term fluctuations that have no bearing on long-term outcomes, to be swayed by confident-sounding pundits whose track records on prediction are no better than chance. One of the quieter, more useful habits for a long-term investor is to reduce how often they consume financial news, to check their portfolio less often, to accept that the daily noise is largely irrelevant to outcomes measured over decades. This sounds passive, even negligent, but it's actually a form of active self-discipline, a resistance to the constant pull of short-term information that most of us are poorly equipped, evolutionarily, to ignore. Let's spend some time now thinking about bonds, because they're intimately connected to the stock market and to understanding the broader context in which stocks operate. When a government or a corporation needs to borrow money, they have options beyond issuing shares. They can issue bonds. A bond is essentially a promise to pay back a borrowed amount at a specified time in the future, along with regular interest payments in the meantime. If you buy a bond, you're not acquiring ownership in anything. you're becoming a creditor. You're lending money, and you'll receive your interest and principal back at the agreed times as long as the borrower doesn't default. Bonds are generally considered less risky than stocks because creditors are paid before shareholders in the event of a company's financial distress. If a company goes bankrupt, the bondholders have a legal claim on the company's assets before equity holders see anything. This priority makes bonds safer, though it also means they typically offer lower expected returns than stocks over long periods. You're accepting less upside in exchange for more security. Government bonds, particularly those issued by stable, credit-worthy governments, are considered among the safest investments in the world. U.S. Treasury bonds, for example, are backed by the full faith and credit of the U.S. government, and because the government can always raise taxes or, in the extreme, print money to meet its obligations, the risk of default is considered essentially zero. The yield, the interest rate you receive, on government bonds is therefore quite low compared to corporate bonds or stocks. You're paying for that safety. The relationship between bond yields and stock prices is one of the important dynamics in financial markets. When bond yields rise, meaning the interest rate on bonds increases, stocks can face headwinds for a few reasons. Higher bond yields mean that the risk-free return available to investors has increased, which makes the riskier return from stocks relatively less attractive. It also means higher borrowing costs for companies, which can reduce their profitability. And as we discussed earlier, higher interest rates mean a higher discount rate, which mathematically reduces the present value of future earnings, which reduces the theoretical value of stocks, particularly those whose value is concentrated in distant future growth. Central banks, by controlling short-term interest rates, have enormous influence over the relative attractiveness of stocks versus bonds, and therefore over stock prices. This is why financial markets pay such close attention to the decisions and communications of central banks like the Federal Reserve. When the Fed signals that it's going to raise rates, the stock market often falls. When it signals it's going to cut rates, the stock market often rises. The mechanism isn't perfectly reliable, and there are many other factors at play, but the basic relationship is robust enough that it shows up consistently over time. The concept of asset allocation, deciding how much of your portfolio to hold in stocks versus bonds versus other asset classes, is one of the fundamental questions of personal investing. The general principle, which is fairly well supported by theory and practice, is that younger investors with longer time horizons can afford to hold more stocks, because they have time to ride out market downturns and benefit from the higher long-term return that stocks tend to provide. Older investors closer to retirement, who can't afford to see their savings cut in half right before they need to start drawing on them, should shift more toward bonds, accepting lower expected returns in exchange for more stability. This is the idea behind the classic advice to subtract your age from 100 to get your stock allocation percentage. If you're 30 years old, hold 70% stocks. If you're 60, hold 40% stocks. It's a rough heuristic, and financial planning is more nuanced than any single formula can capture, but the underlying logic is sound. Your ability to tolerate risk is partly a function of how much time you have to recover from losses. Let's also spend a moment on dividends, because they're an important part of the picture and they're sometimes misunderstood. A dividend is a payment that a company makes to its shareholders, typically on a regular schedule, out of its profits. Not all companies pay dividends. Many, particularly younger, faster-growing companies, prefer to reinvest all their profits back into the business to fuel further growth. Their shareholders benefit not through dividends but through increases in the stock price, which reflect the value being created by that reinvestment. But many mature, established companies do pay dividends, and for certain types of investors, dividend income can be an important source of return. The dividend yield of a stock is the annual dividend per share divided by the share price, expressed as a percentage. If a stock costs $50 and pays $2 in annual dividends, its dividend yield is 4%. This is a meaningful income stream for investors who hold the stock, and it provides a return even in years when the stock price doesn't move or moves lower. Historically, dividends have made up a substantial portion of the total return from holding stocks, particularly over long periods. The compounding effect of reinvesting dividends, buying more shares with the dividend income you receive, can be quite powerful over decades. It's one of the reasons that very long-term charts of stock market performance sometimes look much more impressive than people expect, because they include reinvested dividends, which add up considerably over 30 or 40 years. Companies that pay consistent, growing dividends over long periods are sometimes called dividend aristocrats, and they have a particular appeal to income-oriented investors who want their portfolios to generate a steady stream of cash. The discipline required to maintain a growing dividend, because companies that cut their dividend often see their stock price fall sharply in response, can be a useful signal of a company's underlying financial health and management quality. Now let's talk about something that often puzzles people: the relationship between a company's business performance and its stock price. You might expect these to always move in lockstep. Good business performance equals rising stock price. Poor business performance equals falling stock price. And broadly, over long periods, that's true. But in the short and medium term, the relationship is much messier than that. The key concept here is expectations. Stock prices don't just reflect how a company is currently doing. They reflect how the market expects it to do in the future. And the current price already incorporates the market's current expectations. What moves the price is the difference between what the market expected and what actually happens. This is why a company can report excellent earnings that have grown substantially from the previous year, and still see its stock price fall. If the market had already priced in even better earnings, the actual results, though strong in absolute terms, were a disappointment relative to expectations. The stock falls not because the company did badly, but because it didn't do as well as the market had hoped. Conversely, a company can report flat or even slightly declining earnings and see its stock rise if the market had been expecting much worse. The bar against which results are measured isn't some absolute standard of goodness. It's what the market had already anticipated. This is the mechanism behind the phenomenon where bad news is already priced in, a phrase you'll hear often in financial commentary. Understanding this helps explain one of the most confusing aspects of markets for newcomers: the apparent disconnect between how a company seems to be doing and what its stock price is doing. If you're watching a company report strong growth and wondering why its stock is falling, or watching another company announce layoffs and wondering why its stock is rising, the answer is almost always about expectations and what had already been priced in. This also relates to why contrarian investing, the practice of buying when everyone else is selling and selling when everyone else is buying, can sometimes be effective. If a stock has fallen dramatically, it's often because expectations have become very pessimistic. Bad news has been thoroughly priced in. In that situation, even a modest improvement in the company's fortunes can be enough to trigger a recovery in the stock price, because the bar for exceeding expectations is very low. The challenge is accurately judging when expectations have become excessively pessimistic versus when they're appropriately reflecting genuine problems that are likely to persist or worsen. It's worth noting here that markets aren't always efficient in the short run. There are periods when emotions dominate, when prices overshoot on both the upside and the downside relative to what rational analysis of future earnings would suggest. These periods can create genuine opportunities for investors who are patient and who have done the work to understand what something is truly worth. But they're also where many investors get burned, either by buying into excessive optimism or selling into excessive pessimism at exactly the wrong time. Let's think for a moment about the concept of diversification, because it's central to prudent investing and it's more interesting than it might sound. The basic idea of diversification is to not put all your eggs in one basket. If you put all your money into one company's stock, your financial well-being is entirely tied to how that one company performs. If it does well, great. If it has a bad year, or if something unexpected happens that hurts it, you bear the full impact. If instead you spread your investment across many different companies, in many different industries, perhaps even in many different countries, the specific troubles of any one company or industry have a much smaller effect on your overall portfolio. The ones that are doing well compensate for the ones that are struggling. Your returns are smoother, less volatile, than they would be if you were concentrated. What's mathematically interesting about diversification is that it reduces risk without necessarily reducing expected return. This is because different stocks don't all move together perfectly. Their returns are not perfectly correlated. When technology stocks are struggling, healthcare stocks might be doing fine. When domestic stocks are down, international stocks might be up. This imperfect correlation means that combining assets together smooths out the overall portfolio's performance, reducing the peaks but also reducing the troughs, without necessarily reducing where you end up on average over time. This is the mathematical insight behind what's called modern portfolio theory, developed by economist Harry Markowitz in the 1950s. Markowitz showed that for a given level of expected return, there was an optimal portfolio that minimized risk through diversification. And for a given level of risk, there was an optimal portfolio that maximized expected return. This framework, the efficient frontier as it's called, became enormously influential in how institutional investors think about constructing portfolios. It earned Markowitz a Nobel Prize in Economics in 1990, The practical implication for ordinary investors is fairly simple. Own a lot of things. Don't concentrate your savings in any one stock, or even any one sector. The easiest way to achieve this is through broadly diversified index funds, which by their nature own many hundreds or thousands of different stocks. The cost of diversification through an index fund is essentially nothing above the fund's very low expense ratio. The benefit, in terms of reduced risk for a given level of expected return, is meaningful. There's a psychological element to diversification too. When you own many different things, you're not anxiously checking on any single one. The fate of your portfolio isn't riding on whether a particular company's CEO makes a good decision this quarter. You're betting on the general direction of the economy, not on any specific outcome. This broader bet is one that history suggests is likely to pay off over long periods of time, though it requires patience and the willingness to accept that over short periods, even broadly diversified portfolios can experience significant declines. Let's move now to talk about some of the alternatives to individual stock picking, because there's a whole world of investment approaches that different people take, and understanding the landscape is useful. We've talked about index funds. We've mentioned hedge funds. Let's also talk about the approach of buying individual stocks, what's sometimes called stock picking, because it's what many people imagine when they think about investing. Stock picking involves researching individual companies and deciding which ones to buy, based on your analysis of their business prospects, their financial health, their competitive position, their management quality, and whether their current price represents good value given all of those factors. At its best, stock picking is a rigorous intellectual exercise, requiring deep knowledge of industries, accounting, competitive dynamics, and the ability to form and maintain conviction in your analysis even when the market disagrees with you. There are investors who are very good at it. Warren Buffett, the most famous example, has built one of the great fortunes in history by identifying well-run businesses trading at reasonable prices and holding them for very long periods of time. His approach, influenced by the value investing philosophy of his teacher Benjamin Graham, focuses on understanding the intrinsic value of a business and being willing to buy it when the market price is below that value, creating what Graham called a margin of safety. But Buffett is an exceptional case, and the evidence suggests that most individual investors who try stock picking, and most professional fund managers who do it for a living, don't beat the market over long periods. This isn't because they're not smart or hardworking. It's partly because the market is competitive and information is widely available, making it hard to find genuine edges. It's partly because the costs of active trading, commissions and taxes on gains add up. And it's partly because human psychology, the tendency to hold on to losing positions too long and sell winning ones too early, to chase recent performance, to be overconfident, works against good decision-making in markets. The humbling truth that systematic, unemotional index investing outperforms most stock pickers most of the time has not stopped people from trying to pick stocks, and probably never will. The appeal of the activity, the intellectual engagement, the sense of agency, the possibility of dramatic outperformance, is real even if the statistical odds are sobering. For people who enjoy the process, and can limit their stock-picking activities to a portion of their portfolio, maintaining a boring core of index funds for the majority. There's nothing wrong with it, as long as they're honest with themselves about the likely results. There are also approaches that try to blend active and passive elements. Factor investing, also called smart beta, tries to systematically overweight stocks with certain characteristics that have historically been associated with above-average returns. Size, for example, smaller companies have historically tended to outperform larger ones over long periods, though with more volatility. Value, companies with lower prices relative to their earnings or book value have historically tended to outperform more expensive ones. Momentum, stocks that have been going up tend to continue going up in the near term. Profitability, companies with higher returns on equity tend to outperform. These factors can be captured through rule-based strategies that are more systematic and lower cost than traditional active management. Though whether the historical premiums will persist in the future, now that they're widely known and many investors are trying to exploit them, is an open question. Now let's spend a little time thinking about the global nature of stock markets. Because the stock market isn't just an American institution. Markets exist in countries around the world, and they're increasingly interconnected. The Tokyo Stock Exchange, the London Stock Exchange, the Shanghai and Shenzhen exchanges in China, the Bombay Stock Exchange in India, the Euronext network covering several European countries, and many others are all significant players in the global flow of capital. Companies in different countries can raise capital by listing shares on these exchanges, and investors in different countries can buy shares in foreign companies. This globalization of capital markets means that what happens in one market can quickly affect others. When U.S. markets fall sharply, investors around the world take notice, and markets in Asia and Europe often open lower the following day, reflecting that concern. When a major economy faces a financial crisis, the shocks can spread through interconnected markets globally, as the financial crisis of 2008 demonstrated. The world's major financial markets are now deeply integrated in a way that wasn't true even a few decades ago. For individual investors, this global integration creates both opportunities and challenges. The opportunity is diversification across different economies and markets. Different countries have different economic cycles, different growth trajectories, different industries. Investing internationally can provide exposure to growth that isn't available domestically, and can reduce the dependence of your portfolio on any single country's fortunes. The challenge is that global diversification doesn't always work as smoothly as you'd hope. In times of market stress, correlations between global markets tend to rise. The very moment when you most want your international holdings to provide cushion, they often fall alongside domestic holdings. The phrase, "all correlations go to one in a crisis," captures this phenomenon, though it's an overstatement. Currency risk is another complication for international investing. If you're an American investor buying shares in a Japanese company, you're not just making a bet on the company. You're also implicitly making a bet on the exchange rate between the dollar and the yen. If the yen falls against the dollar while you own the shares, your returns in dollar terms will be lower than the returns you'd see measured in yen. currency movements can add or subtract meaningfully from international investment returns, and they're notoriously difficult to predict. Despite these complications, most financial advisors suggest that a globally diversified portfolio, one that includes meaningful exposure to international markets, is appropriate for most long-term investors. The exact proportion, how much to allocate internationally versus domestically, is a matter of some debate, and it varies with circumstances. But the general principle of not limiting yourself to just one country's market is broadly accepted. There's also the question of emerging markets, a term used to describe economies that are developing rapidly but haven't yet reached the level of income or institutional development of the world's wealthiest countries. Countries like China, India, Brazil, Indonesia, Mexico, South Africa, and many others are considered emerging markets. Their stock markets offer exposure to potentially faster economic growth than is available in more mature economies, but also to more volatility, more political and regulatory risk, and more currency risk. Investing in emerging markets requires a higher tolerance for uncertainty and a longer time horizon to ride out the inevitable periods of turbulence. But for investors who have those qualities, emerging markets can be a meaningful part of a diversified global portfolio, capturing some of the growth that's happening in the parts of the world where living standards are rising most rapidly. We've covered a great deal of ground, and there's something worth reflecting on in all of it. The stock market, when you look at it close up, can seem bewildering. So many moving parts, so much information, so many different participants with different strategies and different objectives, all interacting in a system that produces prices that sometimes seem rational and sometimes seem anything but. It's easy to feel like you can't possibly understand it well enough to participate sensibly. But the core of it, the fundamental logic, is actually not that complicated. Businesses create value. Owning shares in those businesses means participating in that value creation over time. The market is a mechanism for pooling capital, for allowing people to buy and sell ownership stakes, and for producing prices that reflect, imperfectly but reasonably well over time, the collective assessment of what businesses are worth. The emotional ups and downs, the bubbles and crashes, the noise and the complexity are real, but they're overlaid on top of this simpler underlying reality. For the ordinary person trying to save for retirement, or to build wealth over time, the essentials are fairly simple even if they're not always easy. Save consistently. Invest in broadly diversified, low-cost index funds. Don't react to short-term fluctuations. Stay the course through downturns. Be patient. Time is your most valuable asset. The power of compounding, the process by which returns generate further returns year after year, is genuinely remarkable over long periods. $1 invested at 7% annual return becomes nearly $4 in 20 years, and nearly $8 in 30 years. You don't need to be a financial genius or to take dramatic risks to benefit from those kinds of returns. You just need to participate consistently and have the patience to let the process work. Let's take one more slow turn through the landscape before we wind down, and think about some of the ways in which the stock market connects to everyday life in ways that aren't immediately obvious. When companies can raise money cheaply through equity markets, they can invest in research and development, in new products, and expanding into new markets. Some of the most important innovations of the past century were funded through capital raised in public markets. The development of new drugs, new technologies, new energy systems, new transportation infrastructure. The stock market isn't just a mechanism for investors to grow their savings. It's also, when it's working well, a mechanism for directing capital toward productive uses, for funding the activities that create the goods and services that improve human lives. The relationship isn't perfect, and there are legitimate critiques of how capital markets direct resources. Short-term pressures from public shareholders can sometimes push company managers toward decisions that boost quarterly earnings at the expense of long-term investment. The incentive to maximize shareholder value can sometimes conflict with other values: environmental sustainability, fair treatment of workers, responsibility to communities. These are real tensions that thoughtful people disagree about, and they don't have simple answers. But at their best, efficient capital markets allocate resources toward their most productive uses, funding the companies and industries that are creating the most value, and withdrawing resources from those that are destroying it. This allocation function is one of the genuine and important contributions of financial markets to economic progress. Pension funds, which own stocks in order to generate the returns needed to pay future retirees, connect the stock market to the financial security of millions of ordinary people who may never think about investing at all. The teacher who retires with a comfortable pension, the factory worker whose defined benefit plan provides income in old age, the public employee whose state pension fund has been carefully invested for decades. All of these people's financial security is in some meaningful way connected to how the stock market has performed over the course of their careers. And the growing prevalence of individual retirement accounts, of 401k plans, of IRAs and their equivalents in other countries, has made that connection more direct and more personal. More people than ever before are making, or at least nominally overseeing, investment decisions that will materially affect their financial security. Understanding the basic principles of how markets work, even at a general level, has become a form of practical literacy that matters to ordinary life. There's something worth sitting with here as we move toward closing. The stock market is often talked about in the financial press as a score, a number that goes up or down and tells you how things are going. And there's a sense in which that's true. But it's also a window into something much larger, into the way human beings collectively organize the allocation of resources and manage uncertainty about the future. It's a system built over centuries, through trial and error, through crises and reforms and technological transformations, to accomplish something genuinely difficult: to match people who have capital with the activities that can put that capital to productive use, and to do this in a way that's reasonably fair, reasonably efficient, and reasonably stable most of the time. It's not a perfect system. It never has been. It has its irrational moments, its episodes of collective folly, its tendency toward excess in both directions. It can be a vehicle for the accumulation of wealth in ways that seem disconnected from genuine contribution to society. It can reward luck as much as skill. It can be influenced by the powerful in ways that disadvantage the less powerful. None of that should be dismissed. But it's also a system that has, over the long sweep of history, channeled enormous amounts of human energy and ingenuity into productive activity, that has funded innovations that have extended lives and reduced suffering, that has provided millions of ordinary people with a mechanism for building financial security over decades. Its flaws and its virtues are both real, and a complete understanding requires holding both simultaneously. As you close your eyes and let the day settle around you, you might carry with you just the simplest version of all this. At the heart of every share of stock is someone who needed resources to build something, and someone else who was willing to provide those resources in exchange for a share of whatever that building produced. That exchange, that basic partnership between those who have capital and those who need it, is thousands of years old. The machinery around it has grown extraordinarily complex. But the core of it is as simple as two people shaking hands over a common purpose. The market goes up and down. It always has. It probably always will. But underneath the fluctuations, the trend over very long periods has been upward, because human beings have consistently found ways to create more than they've destroyed. That's not a guarantee about any specific investment or any specific period of time. But it's a pattern robust enough to rest some confidence in, quietly, over the long run. Rest well. There's nothing you need to figure out right now. The market will be there tomorrow, and the day after that, continuing its slow, long, imperfect journey in the general direction of more.